very much, Diana. Good morning, everyone. It's a pleasure to be back here, and this is always a great group to speak with, although I have to admit, when I first walked in the room and heard Diana mention that this was a forum of great thinkers, I felt a little intimidated. You know, that's something that I would reserve in terms of the accolades for people like Jay Myers, who deserves that, as the organization's done fantastic work. I work on a trading floor. These days, trading floors, great thinkers, it's a bit of a tough sell in the global economy. It's, in fact, two telltale characteristics of the kind of environment we've been in the last couple of years. Myself and a number of my colleagues have generally tended to give up caffeine a lot more than in the past. And number two, I swear to God, no joke, no word of a lie, our Health and Safety Committee took the opportunity through this crisis to install defibrillators on the walls of our trading floor. That's an indication of the kind of environment we've been in the past 2 to 3 years. What I have in mind for the next 15 minutes or thereabouts is to not put you through any exercises. Neil did a fantastic job at that. Instead, I frankly intend to give you a frank assessment of where we think the Canadian economy is going over the next few years. We are at a transition point in terms of what we can rely upon to drive the Canadian economy in the context of a fairly weak global economic backdrop that will present a number of risks, but against that, a number of opportunities, including to many of you, the business people who are running our economy on a day-to-day basis. I've tipped our hat right off the bat in the title to this presentation in terms of where I'm going with this. We are not going to enjoy a repeat of the past 10 years in which the Canadian economy has outpaced many of our G7 peers on average annual economic growth throughout this period of time, principally because of the outperformance of our consumer sector and our housing markets. Those days are done. They're gone. We've pretty much booked about as many of the gains as we can expect from those sectors going forward. You, our business people, our exporters, sources of net trade, these are the sources of strength that we are going to have to rely upon more aggressively in order to steer the ship over the course of the next few years. And we are going to grow at a considerably softer pace than what we've become accustomed to in the last few years. And as we go through the presentation, I'll mention the pros and cons to the net outcome of the general take on the economy. To start off with, just a couple of points, brief points about the U.S. economy. We're not terribly upbeat on the continued outlook for the U.S. In fact, I think they've entered a nasty period of political divide in the U.S. Congress. That's going to lead to an outright stalemate in terms of the prospects for fiscal policy to do any of the heavy lifting required throughout the rest of this very, very muted, soft, volatile recovery that the U.S. is going through. The two key debates are whether or not there will be enough meeting of the minds in the middle in order to extend jobless benefits that expire at the end of this month, but also to extend tax cuts that expire at the end of this year. This is going back to the Bush administration's tax cuts that were implemented in 2001 and 2003, and that all expire by the end of this year, including for marginal personal income tax rates, estate tax rates on investment returns. A broad variety of taxes are slated to go up at the end of this year by multiples of percentage points for all different classes of income earners. The Obama administration says, well, we'll extend those tax cuts for households earning up to $250,000 a year, but beyond that, you're on your own. In our view, if that's all that they do, and there isn't a greater meeting of the minds, then we can look forward to a step back in U.S. consumption as we go off into next year. And on this, we would side with the thinking by respected economists like Martin Feldstein at Harvard University and past president of the National Bureau of Economic Research. And we would point to research we've done that argues that it's the upper income earners who have done much of the heavy lifting on the consumer spending cycle in the past and who are doing much of it now. Even when you look at Mercedes-Benz sales in the United States, it's the US and China that are that company's top 2 sales markets in the world right now. The luxury goods segment is doing quite well. The upper income earners are what have driven 40 to 50% of aggregate consumption growth in the US economy. Obama is not doing a great service to the debate by essentially committing himself not to extend tax cuts for the upper earners by saying that he doesn't want to give tax cuts to millionaires and billionaires. That's not the kind of income segment that we're dealing with here. If we don't get a greater meeting of the minds in the middle on this count, then I think we're looking at a very rocky road for U.S. consumption off into next year and a higher personal income. The other concern that we have, however, in a broader context, in the broader fiscal policy political landscape, is that fiscal policy is about to turn direction in the U.S. economy toward being much more restrictive than it has tended to be in the past 1 to 2 years. Just by virtue of taking the Obama administration's net stimulus profile for spending and tax revenue and spending numbers over the course of the next few years, we crest right about now in terms of its contributions to economic growth and then start to wane on a quarter-to-quarter basis. basis and see fiscal stimulus coming out of the system. That is sparking a debate with a wide variety of opinions on how exactly it will translate in terms of a hit into U.S. economic growth off into next year and the year beyond. The Bank of Canada's assumption is essentially don't worry, be happy, and it's less than 1 percentage point drag on U.S. economic growth as we go off over the next 1 to 2 years. Other respected economists, like Robert Barrow at Harvard University, would argue that, well, no, be careful here. The multipliers are a lot more severe than perhaps what people like the Bank of Canada are assuming. You have to knock maybe 2.5 percentage points, maybe even more, off of U.S. economic growth throughout this transition period. That means that it's going to require enormous strength in the private economy to pick up the slack and eke out pretty modest economic growth rates in U.S. GDP over the course of the next couple of years. In fact, so much so that we think we need 5–6% growth in private demand, consumption, business investment, the whole, and housing markets, in order to absorb the impact of this coming fiscal crunch that's going to really have binding effects on U.S. growth prospects. Why do we care? We're the most affected in Canada in terms of the U.S. growth prospects among major regions around the world. For every 1 percentage point hit to U.S. economic growth, we get dinged by about a ½ percentage point in terms of long-run average studies. One might even argue that it's a bit of a greater hit in terms of some of the sensitivities that the IMF has estimated over this longer run period if we evaluate it in the current context. That's why people like Mark Carney, Governor of the Bank of Canada, are very, very concerned about the outlook for the U.S. economy. That's why rates are on hold in Canada, in our view, with short-term interest rates parked where they are until the fall of next year. In part because of the uncertainties over the political landscape, the fiscal policy outlook for the U.S. economy, the broad direction of the U.S. economy, and then domestic concerns that are going to be the dominant focus of the rest of my presentation. In fact, this is the punchline in terms of the rates outlook. If you are an investor, forget floating rate notes, forget money markets. You will not earn considerable returns on your cash holdings throughout this entire environment over the course of the next couple of years. I think we're in a prolonged environment of very, very low short-term interest rates. In fact, further up the curve, I would expect that to also be characteristic. Business borrowing costs, I think, are going to be very supportive of your capital spending plans. Great opportunity, once-in-a-lifetime opportunity to retool your operations, given particularly the impact of low interest rates, an elevated level of the Canadian dollar, given that we tend to import over 2/3 of our capital goods spending from the United States. So great opportunity to import computer, software, machinery, and equipment. We have the balance sheet strengths in Canada on the corporate balance sheet picture to support this, and we have tax incentives on top of it all that go throughout much of next year. The downside, however, and the next few charts after 1 year are going to be a little bit bleak, but I'll end on a positive. If for no other reason than the fact that the liability costs to getting insurance on presentations like this, if you leave people at the end of the presentation on a bleak note, are just prohibitively expensive. We've tapped out in terms of the potential for our consumer and housing markets to continue to drive growth in the Canadian economy. The home ownership rate is at an all-time record high. The last time it was measured was 2006, and even then it was a record high. Unfortunately, because of the foolish, short-sighted measure of the federal government to drop the long census, we won't get an update on the home ownership rate in the 2011 census. So we're left guessing as to how many people actually own homes in Canada. And our guesstimate right now is that about 70% of Canadians are in homes. That's higher than the U.S. home ownership rate had peaked out at 69% back in 2006 or thereabouts. It has since drifted a few percentage points lower than that. We put more people into homes today in the Canadian economy than we've ever done in the course of history in the past. Because of low rates, because of mortgage innovation that started in 2007, because we're taking on riskier borrowing appetite, people going longer-term amortizations, insured investor mortgages arrived only 2 to 3 years ago. We've changed the dynamics of the landscape in terms of this argument. I don't think going forward that we can expect continued gains in that regard. In fact, I think this is showing a cycle topping out in the home ownership cycle. And in fact, going forward over the next 3 to 5 years, if we want to talk broad themes for the business lending environments, I think you can expect, at best, housing market demand to run in line with the broad population dynamics, the rate of entry into home ownership cohorts, the demographic fundamentals, as opposed to pulling in higher percentages of people into home ownership.